A foolish consistency is the hobgoblin of little minds, adored by little statesmen and philosophers and divines.
If a man does not keep pace with his companions, perhaps it is because he hears a different drummer. A different drummer.
And now, coming to you from dead center on your dial, welcome to Risk Parity Radio, where we explore alternatives in asset allocations for the do-it-yourself investor. Broadcasting to you now from the comfort of his easy chair, here is your host, Frank Vasquez.
Thank you, Mary, and welcome to Risk Parity Radio, episode 400. Today on Risk Parity Radio, we're going to take a break from our regularly scheduled programming and offer you what we will call a reference episode that is designed to help new listeners, but may help some of the old ones too. So this episode will be summarizing the contents of our foundational episodes 1, 3, 5, 7, and 9, which you might want to listen to after you listen to this, if you have not already. To accomplish that, we are using the services of an artificial intelligence large language model device that will create podcasts for you out of the material that you give it. And we have fed into the large language model the contents of each of the episodes 1, 3, 5, 7, and 9, along with the links and other materials that go with those episodes. And so what you will be hearing here are 5 separate little podcasts in a row that reflect episodes 1, 3, 5, 7, and 9. And you will also find in the show notes all of the links that you would previously find for episodes 1, 3, 5, 7, and 9, copied all into one place for your convenience. So you will not be hearing much of my voice or my antics today.
You are talking about the nonsensical ravings of a lunatic mind.
And finally, just one caveat. Although the large language model podcast is pretty good, it does mess things up sometimes, and I would say its accuracy is generally only about 85 to 90%. So when in doubt, please do rely on the original episodes of 1, 3, 5, 7, and 9. And so without further ado. First off, we have episode 1.
All right, so we're going to be looking into this Risk Parity Radio. It's a new personal finance podcast.
Yeah.
And it's focused on this concept called risk parity.
Okay.
I got to admit, the name itself kind of makes it sound like some kind of secret society for investors.
It does have a certain mystique to it, doesn't it? But, at its core, it's about building a portfolio that can weather different economic storms, right? So instead of just thinking about how much you're putting in stocks versus bonds, it's really about diversifying strategically across a range of assets that react differently to different conditions in the market.
Okay, so it's not just about picking the right stocks or bonds.
Right.
It's about creating like a more resilient portfolio overall.
Exactly.
And this podcast, Risk Parity Radio, seems to be all about showing you how to do that yourself.
Yeah, they give you really actionable advice.
Okay.
Not just theoretical concepts.
Okay.
They have real portfolios that they're tracking and monitoring on their website.
Okay, got it.
And they do 2 episodes every week. One is more discussion-based, and the other one is a portfolio review.
Okay.
So it's www.riskparityradio.com if you want to check it out.
But with 6 different portfolios that they're tracking, I'm already feeling a bit overwhelmed.
Yeah.
How would someone even know where to begin?
Well, that's a fair point.
Yeah.
6 portfolios is a lot to take in, especially if this is a new approach to you. But that's where understanding the logic behind each one comes in.
Okay.
Right? They're not just random groups of assets.
Yeah.
Each one is built based on specific principles and goals.
Okay.
For example, the All Seasons portfolio, which is inspired by Ray Dalio, right? Aims to perform well across different economic scenarios like inflation, deflation, growth, recession, you name it.
Okay.
It's like building a financial fortress designed to withstand any kind of weather.
So it's about having a strategy that's not just chasing those high returns,
Yeah.
but also protecting your capital when things get a little rocky.
Right, exactly.
Yeah, that makes a lot of sense,
Oh.
especially with today's unpredictable market.
Yeah.
But what about those good uncorrelated bets that we were talking about?
Yeah.
How do those fit into the risk parity picture?
That's a key piece.
Okay.
Uncorrelated assets are those that don't move in the same direction as the stock market.
Okay.
So while stocks might be doing really well,
Yeah.
these assets might be holding steady or even going up slightly.
Okay.
Think of it like having backup generators for your house.
Mm-hmm.
If the main power grid goes down, you've still got some lights on, right?
So it's like having a plan B.
Exactly. Or even a plan C.
Yeah, or a plan C built into your portfolio.
Right.
That's pretty clever.
Yeah.
But actually finding these uncorrelated investments,
Yeah.
that sounds like it could require like a PhD in finance.
It can seem daunting,
Yeah.
but that's where Risk Parity Radio comes in.
Okay.
They really break down these concepts into bite-sized pieces, you know?
Okay.
They use real-world examples and even some humor to make it all less intimidating.
Yeah.
And then by tracking these 6 portfolios, they're basically doing the research for you. They're showing you how these strategies actually perform in real time.
Okay, so they're kind of taking the guesswork out of it.
Right.
Which is definitely appealing.
Yeah.
But you mentioned that each portfolio has its own logic and goals.
They do.
Can you give me an example of how they differ?
Absolutely. Let's take the Golden Butterfly portfolio.
Okay.
This one incorporates a mix of stocks, bonds, gold, and commodities.
Okay.
And it's designed to be relatively conservative, aiming for steady growth with lower volatility than just a pure stock portfolio.
Okay.
And the name Golden Butterfly actually comes from the shape of its risk profile when you chart it out. It's a visual representation of how the portfolio is designed to perform in different market conditions.
Interesting. So there's a reason behind the name.
Yeah.
It's not just like a catchy marketing ploy. But with all this talk of diversification and these uncorrelated assets, I'm wondering if there's a risk of spreading yourself too thin.
Okay.
Could some of these assets still lose value even if they're not directly tied to the stock market?
That's a really smart question.
Yeah.
And it's one that Frank Vasquez addresses head on in the podcast.
Okay.
He acknowledges that no investment strategy is foolproof, right?
Yeah.
Even with diversification, there's always a risk, like a perfect storm scenario,
Right.
where multiple asset classes take a hit.
Okay. So it's not about eliminating risk entirely.
Exactly.
But it's about managing it in a way that aligns with your goals and your comfort level.
Exactly. Risk parity is about recognizing that risk is inherent in any investment. And it's about finding that balance, right?
Yeah.
Between the potential reward and the potential downside.
Okay.
It's more nuanced than just chasing the highest returns or hiding all your money under a mattress.
Right. And speaking of nuance,
Yeah.
let's talk about these experimental portfolios
Okay.
that involve leverage.
Okay.
Those sound a little riskier, right?
They do carry more risk,
Okay.
but also the potential for higher returns.
Yeah.
Leverage essentially means using borrowed money
Okay.
to amplify your investment.
Okay.
Think of it like using a lever to lift a heavy object. You can move more weight with less effort.
Okay.
But if you lose control of that lever, things can go wrong quickly.
So it's a powerful tool,
It is.
but one that needs to be handled with extreme caution.
Yes, exactly.
Tell me more about these leverage portfolios.
Okay, so one of them is the accelerated permanent portfolio.
Okay.
It takes the classic permanent portfolio, which is known for its stability,
Yeah.
and adds leverage to potentially boost returns.
Okay.
Then there's the accelerated 50-50, which takes the traditional approach of splitting your investments equally between stocks and bonds.
Right.
And, you guessed it, adds leverage to the mix.
Okay, so these are like the turbocharged versions
exactly.
of those more conservative strategies.
Right.
But before I get too excited about these turbocharged returns, I have to ask, what kind of downsides are we talking about here?
Well, the main downside is that leverage magnifies both gains and losses.
Okay.
So if your investments go up, you'll see bigger profits. But if they go down, your losses will be amplified as well.
Okay.
It's not a strategy for the faint of heart
Right.
or for those who can't stomach volatility.
So it's not a free lunch.
Right.
You're taking on more risk
Exactly.
in exchange for the potential for those higher returns.
That's a great way to put it.
Yeah.
And that's why Risk Parity Radio emphasizes really understanding your own risk tolerance before you go into any investment strategy, especially one that involves leverage.
Right. That's a responsible approach.
It is.
It sounds like they're not just throwing out ideas.
No.
They're really trying to guide listeners to make informed decisions that align with their situation.
Exactly.
Yeah.
They're giving you the tools and knowledge, but ultimately the decision of what to invest in and how much risk to take is up to you.
Right.
It's about becoming your own financial architect, so to speak.
I like that analogy.
Yeah.
The financial architect.
Yeah.
It implies that there's a thoughtful process.
Exactly.
It's not just throwing darts at a stock board or something.
Right.
But with all this talk of portfolios and strategies, I'm kind of wondering about the man behind the curtain. What can you tell me about this Frank Vasquez?
Well, from what I've gathered, Frank Vasquez is a seasoned investor.
Okay.
And he seems really passionate about sharing his knowledge and empowering people to take control of their finances. He seems very down to earth.
Okay.
No flashy guru vibes or get-rich-quick schemes.
So he's not promising overnight riches.
No, not at all.
Or selling some secret formula.
Not at all. Okay. He's very transparent about the risks involved in investing.
Yeah.
And he really emphasizes the importance of a long-term evidence-based approach.
Yeah.
He even encourages listeners to challenge his ideas and to do their own research.
Okay. I appreciate that.
Yeah.
It shows that he's not just trying to push his own agenda.
Right.
He genuinely wants listeners to become, informed and empowered investors.
Precisely. He seems to believe that knowledge is power.
Yeah.
Especially when it comes to money.
That's a philosophy I can get behind.
Yeah, for sure.
It sounds like Risk Parity Radio is more than just a podcast.
It is.
It's like a community.
Yeah.
A learning resource. A guide for anyone who wants to take control of their financial future.
It definitely seems that way.
Yeah.
And what's really interesting is that Frank Vasquez weaves in a lot of historical context into his discussions.
Okay.
He talks about investment strategies that predate modern markets, which I think helps us to understand the underlying principles of risk parity.
Yeah.
And how it's evolved over time.
So it's not just some newfangled trend.
Right.
It's a strategy that's got some deep roots.
Exactly.
That adds a layer of credibility, don't you think?
Absolutely.
Yeah.
And, it shows that these principles have stood the test of time.
Right.
Which is reassuring when you're dealing with something as important as your financial well-being.
Okay, so we've established that this Risk Parity Radio is about building resilient portfolios.
Right.
Understanding risk and finding those good uncorrelated bets. But why should someone actually invest their time and energy into learning about this approach? What are the potential benefits?
Well, I think the most compelling benefit is that risk parity is really designed for long-term success.
Okay.
It's not about chasing quick returns or trying to time the market. It's about building a robust portfolio that can weather those different economic storms and generate consistent returns over time.
Okay.
Like planting a tree that will provide shade for years to come, rather than trying to grow a quick crop that might wither in the next drought.
That's a powerful analogy.
Yeah.
So it's about creating a portfolio that can support your long-term goals.
Okay.
Whether that's retiring, buying a house, funding your children's education.
Right. All of that.
And risk parity can be particularly appealing for those approaching retirement.
Absolutely.
Or those who are already retired, right?
Yes.
By diversifying beyond those traditional stock and bond allocations, you can potentially reduce volatility and protect your nest egg from those market swings.
Right. It's a huge concern for a lot of retirees.
It is, especially for those who rely on those investments for income, right?
Absolutely.
Yeah.
And remember, risk parity isn't just about playing defense, right? It's also about seeking growth opportunities, but in a way that aligns with your risk tolerance.
So it's not about sacrificing returns for safety.
No, not at all.
It's about finding that sweet spot between the two.
Exactly. And by understanding these principles, you can potentially achieve better risk-adjusted returns over the long run, which means more potential for growth without taking on too much risk.
That sounds like a win-win.
It is.
Okay, I'm sold.
Good.
This Risk Parity Radio is definitely worth a listen.
It is.
But before I go down this rabbit hole,
is
there anything else we should know about those 6 portfolios that they're tracking?
Right.
You mentioned the All Seasons and the Golden Butterfly. But what about the other 4?
You're right. We've only just scratched the surface here.
Yeah.
Let's dive into those other 4 portfolios. Okay. You mentioned the golden ratio, right?
Yeah, the golden ratio. This is where Frank Vasquez seems to put his money where his mouth is.
Okay.
He actually uses this one himself. And instead of just throwing a bunch of assets together, this portfolio uses the golden ratio.
Right.
That mathematical concept you see everywhere.
Yeah.
From nature to art.
Yeah.
To determine the allocation.
Interesting.
Across those different assets.
So he's not just diversifying for the sake of diversification.
Right.
There's an actual mathematical framework.
Yeah.
Guiding the allocation.
Yeah.
I'm sensing a theme here.
Yeah.
A blend of historical context and mathematical principles applied to investing today.
Yeah. Yeah, I like that.
What about that fourth portfolio?
Okay.
The risk parity ultimate.
Yeah, the risk parity ultimate. Well, from what I've gathered, ultimate is a pretty apt description.
Okay.
This one's for like the truly hardcore diversifiers.
Okay.
It aims to include a wider range of asset classes than any of the others.
Got it.
Kind of casting a wider net for those uncorrelated returns.
So it's the go big or go home version?
Yeah, I guess you could say that.
Of risk parity? Okay, now, the last two portfolios.
Yeah.
The ones you said were experimental that involve leverage.
Yeah.
This sounds like walking a tightrope.
It does. They're definitely not for the risk averse.
Right.
These portfolios take two classic approaches.
Yeah.
The permanent portfolio and the 50-50 portfolio. And kick them up a notch by using borrowed money to try and like supercharge the returns.
So it's like adding rocket boosters.
Yeah, basically.
To an already solid engine.
Yeah.
Okay, the potential's there.
Yeah.
But so is the risk.
Right.
So can you talk a little bit more about how these accelerated portfolios actually work?
Okay, so the first one, the accelerated permanent portfolio, builds on this strategy.
Okay.
Developed by Harry Brown back in the 1980s.
Right.
The original permanent portfolio was really aimed at creating a stable portfolio that could weather any economic storm.
Okay.
This accelerated version adds leverage to the mix, which, as we said, could potentially amplify gains, but also losses.
Losses, too, right?
Yeah.
I'm noticing a trend here.
Yeah.
Frank Vasquez seems to be taking these proven strategies and exploring how they can be adapted and potentially enhanced for the modern investing landscape.
I think that's a really good point.
What about that accelerated 50-50 portfolio?
Okay, well, that one's a bit simpler in concept.
Okay.
It takes the classic 50-50 approach.
Right, big cloud.
You know, half your money in stocks, half in bonds.
Yeah.
And as you can guess, adds leverage to try and boost returns.
So just adding a little spice to it?
Yeah, like adding a spicy kick to a tried and true recipe.
Exactly.
Yeah.
I really like how Frank Vasquez tests these strategies in such a realistic way.
Yeah.
It's one thing to look at historical data, but to actually see how these portfolios perform when you're taking money out of them, like someone would in retirement, for instance.
Yeah.
I think it just adds a layer of practicality.
It does. It really does.
To the whole thing.
Yeah.
It's not just playing with numbers on a spreadsheet.
Right.
He's simulating real-life scenarios, which I think is what sets this podcast apart. It shows you how these portfolios could actually work for you.
Exactly.
If you were relying on them for income.
That's a really crucial point.
It is.
A lot of investment strategies might look great on paper.
They do.
But when you actually start withdrawing money, especially during market downturns,
exactly,
they completely fall apart.
It's true.
So seeing this more practical approach, it's really refreshing.
It is.
Don't you think?
Absolutely.
Yeah, and it shows that commitment to transparency and a genuine desire to help listeners make informed choices.
Right. He's not just saying, trust me, this will work.
Right.
He's showing you the data, the good and the bad.
The warts and all.
And letting you decide for yourself.
Yeah. It's like he's saying, here's the roadmap.
Exactly.
Here are the potential pitfalls.
Yeah.
Now let's navigate this together.
I like that.
And the fact that he's sharing all of this information for free on his website and his podcast is remarkable.
It is.
He's not trying to sell you anything.
Right.
He's really just trying to give you the tools and the knowledge to become a more confident investor.
A more empowered investor.
Yeah, a more empowered investor, exactly.
It's really a breath of fresh air.
Yeah.
In a world where everyone's always trying to sell you something.
I know, it really is.
It shows a genuine desire to educate and empower rather than just profit,
Yeah, and as we've been talking, I've been thinking, this isn't just about picking investments.
Right.
It's about, adopting a mindset.
Yeah, totally.
Like a whole way of thinking about your financial future.
It is. It's about shifting your perspective. Yeah. Risk parity is more than just a set of rules or formulas. It's a philosophy.
Okay.
It's a way of thinking about your financial life.
Right.
With intention, with knowledge, and with a long-term view.
And that long-term view is so important.
It is.
So it's about becoming like a more thoughtful investor.
Exactly.
A more informed investor.
Right. Not just blindly following the crowd.
Right.
Or chasing the latest hot stock tip.
Yeah, exactly.
It's about taking ownership
of
your financial destiny. You're not just handing it over to someone else and hoping for the best.
Yeah, it's about becoming the captain of your own financial ship.
Yes. I love that analogy. It's like Risk Parity Radio is giving you those navigational tools and those charts to help you steer your ship in the right direction.
In the right direction, yeah. But even with the best tools,
right,
there are going to be challenges and uncertainty along the way. Right.
Of course.
Investing is a journey.
It is.
It's not a destination.
Not a destination.
There will be ups and downs, market swings, unexpected events.
Absolutely.
But the key is to have a solid plan, a well-diversified portfolio, and the knowledge to adapt to those changing conditions.
I think that's where the real value of Risk Parity Radio lies. It's not just about giving you specific recommendations. It's about equipping you with the knowledge and the mindset to navigate the complexities of the market and make those smart decisions.
Yeah, those informed decisions.
That really align with your own needs and goals.
It's about becoming a more confident and empowered investor. Capable of weathering the storms and charting your own course towards financial well-being.
Well said.
But before we wrap up, there's one question that's been kind of lingering in my mind. We've talked a lot about the what of Risk Parity Radio.
Right.
The portfolios, the strategies, the concepts. But what about the WHY?
Okay.
Why should someone invest their time and energy in learning about this approach? What are those potential benefits that go beyond just building that resilient portfolio?
That's a great question, and I think it really gets at why this whole concept of Risk Parity Radio has resonated with so many people.
Yeah.
It's not just about the mechanics of investing, you know? It's something bigger than that.
Yeah.
For me, the WHY of Risk Parity is all about peace of mind.
Okay.
When it comes to your finances, right? Knowing that you've built a portfolio that's designed to weather those inevitable ups and downs that the market throws at you.
So it's about taking control and reducing anxiety.
Yeah.
Especially if you're relying on those investments for income in retirement or for other long-term goals.
It's about that confidence that you've got a plan in place, that you're not just like at the mercy of market forces.
Yeah.
And that peace of mind can be so valuable.
Yeah.
It frees you up to focus on the things that matter most in life, knowing that your finances are taken care of.
You know, as we've been talking, I've been thinking about how this approach contrasts with the advice you typically hear.
Yeah.
From like financial gurus and experts. You know, the buy low, sell high, time the market, pick the winning stocks.
Yeah, all that stuff.
It's almost like risk parity is like a rejection of that whole mindset.
It is, in a way. It's about recognizing that trying to outsmart the market is impossible.
Yeah.
Instead, you have to accept that risk is a part of investing and manage that risk strategically.
So it's not about beating the market.
Right.
It's about building a portfolio that can perform well.
Exactly.
Regardless of what the market does.
Yeah.
And that can be really empowering, I think.
It is.
For those individual investors.
Yeah, it takes the pressure off of trying to pick the right stock or time the market perfectly.
Yeah.
Instead, you're focused on building that solid foundation, that portfolio that's built for the long term.
Yeah.
Not just the quick wins.
Right. And that, I think, is what makes risk parity so compelling.
It is.
It shifts that focus from speculation to strategy.
Exactly.
It's about making thoughtful decisions based on historical data, sound principles, and understanding your own risk tolerance.
Well said.
I'm really impressed by what I've learned about Risk Parity Radio.
Yeah, me too.
It's clear that this podcast offers so much valuable information.
It does.
And insights for anyone who's serious about taking control of their financial future.
I agree. And I think the key takeaway for our listeners is that this is just the beginning, you know?
Yeah.
There's so much more to explore and learn and apply.
It's a journey.
It is.
And Risk Parity Radio gives you that roadmap.
It does.
So for our listener who's now intrigued by this whole idea of risk parity, what would you recommend?
Well, I would say dive into the Risk Parity Radio website.
Okay.
It's www.riskparityradio.com.
Right.
And explore the resources they have there. Listen to the podcast.
Okay.
Look at the portfolio data. And most importantly, engage with that community.
Yeah.
Ask questions, share your thoughts.
Yeah.
And don't be afraid to challenge those conventional ideas,
Right.
The best investors are always learning.
Excellent advice.
Thank you.
And who knows, maybe our listener will be sharing their own risk parity insights on the podcast someday.
That'll be great.
Inspiring others to take control of their financial lives.
I love it.
And until then, happy investing, everyone.
Happy investing.
Remember, knowledge is power, and Risk Parity Radio is a great source of both.
Couldn't agree more.
And of course, we're always here for another deep dive.
Yeah.
Ready to explore whatever topic you throw our way next time.
Looking forward to it.
Yeah.
Second off, we have episode 3.
All right, so today we're going to be diving into something I think is pretty important to, well, everyone, right? Managing money. Making smart choices with our finances. And, you sent over some really interesting material for this deep dive, blending like ancient wisdom, Talmud, and all that with modern financial research. I got to say, I'm intrigued.
Yeah, it's kind of an unexpected pairing, right? But what we're going to find is that there's this piece of financial advice in the Talmud, which, is over 1,500 years old, that it actually aligns with some pretty sophisticated modern-day investment strategies.
Wow. Okay, that's pretty wild. What exactly do the Talmud say about, managing money?
Well, there's this passage in Bava Metzia 42a, and it basically it advises a wise person to divide their wealth into 3 parts: land, business, and at hand.
Hold on a second. This advice is from a time way before we had stocks, bonds, even paper money. I mean, what did land and business even mean back then?
Right. It's fascinating, isn't it? Land in those days would have been pretty much the equivalent of real estate today, right? I mean, you could even kind of stretch that to include modern investments like REITs, those companies that own and manage properties.
Okay, yeah, I see the connection there. But what about business? That seems, I don't know, pretty broad.
It is, yeah, it is broad. And that's where things get kind of interesting. Think of business in today's world as, representing stocks, maybe even owning a private company, or even investing in like venture capital, something like that.
So that leaves us with at hand. Does that mean like, stuffing gold coins under your mattress?
Well, not quite. Although, back then it probably did involve precious metals. But today, think of at hand as, cash or, money market funds, short-term bonds, that kind of thing. Anything that you can access easily. But here's what's really fascinating, right? Even with this like really simple language, the Talmud it's basically tapping into this core principle of diversification.
Diversification. Yeah, that's definitely a buzzword in finance, right? Mm-hmm. But I think a lot of people, they hear it, but they don't really, fully grasp what it means practically. Can you kind of break that down?
Absolutely. Diversification, it basically means not putting all your eggs in one basket, right? By spreading your investments across different asset classes like we were just talking about, real estate, stocks, cash, you're essentially reducing your risk. If one area of the market takes a hit, well, your entire portfolio isn't going to be wiped out.
So the Talmud, even, 1,500 years ago, was promoting a strategy that's still considered wise today.
It really does. It highlights how some financial wisdom is it's timeless, and we're going to see that again a little later when we talk about modern portfolio theory, which is a 20th century concept that also really emphasizes diversification.
Okay, I'm starting to see how these like seemingly totally different sources connect. But I got to admit, there's another piece of advice in Bava Metzia that kind of leaves me scratching my head a little. Rabbi Shmuel recommends, get this, burying coins in the ground to keep them safe. Mm-hmm. I mean, I can't imagine anyone doing that today, right?
Yeah, it does seem a bit, a bit outdated now, doesn't it? But think about the historical context for a second, Back then, there weren't any secure banking systems like we have now. Mm-hmm. So burying valuables, it was actually a pretty common way to protect yourself against theft.
That was kind of their version of a high security vault.
Exactly. And while the method itself, might seem, pretty outdated, the underlying concern about security is still incredibly relevant today. Think about cybercrime, digital fraud, all of that. It's a good reminder that even though the tools and technology, they change, safeguarding our assets it's a constant challenge.
That's a really good point. So I guess we're ready to fast forward a few centuries, right?
Yeah.
Dive into modern portfolio theory.
Yeah, let's time travel. We're going to the 1950s, where Harry Markowitz he developed what we now know as modern portfolio theory, or MPT for short.
Okay, so this is where things might get a little more complex. How do we make sure we don't lose our listener with all the financial jargon?
Don't worry, I'll keep it clear. So the core concept of MPT is it's all about finding the optimal mix of assets, right, to achieve the highest possible return for a given level of risk. Think of it like, I don't know, like baking a cake. You need the right balance of ingredients, right, to create the perfect taste and texture.
Okay, I'm with you so far.
Yeah.
But how do you actually determine that perfect mix for investments? I mean.
That's where math and statistics come in. MPT, it takes into account factors like historical performance of different assets, how volatile they are, and how they correlate with each other. And this all helps create a visual representation called the efficient frontier.
Efficient frontier. That sounds pretty intimidating. Can you break that down a little visually? I mean.
Okay, so imagine a graph, right, where one axis represents risk and the other represents return. The efficient frontier is basically, it's a curve on this graph. It shows all the portfolios, all the different combinations of investments that offer the highest possible return for each level of risk.
So if my portfolio, it's like below that curve, that means I'm not really getting the most bang for my buck.
You got it. Anything below the efficient frontier, it's considered inefficient, right? Because you could be getting more return for the same level of risk, or you could be taking on less risk for the same return.
So the efficient frontier, it's kind of like it's like a roadmap to making your money work smarter, not harder.
Exactly. And here's the really cool part, right? Even though MPT, it uses all these like really complex equations and stuff, it actually circles back to the same idea that we saw in the Talmud, diversification. It's all about spreading your investments wisely to manage risk and hopefully boost your returns.
It's really amazing how these ideas separate by centuries. Mm-hmm. They still arrive at the same fundamental principle. So how did this theory kind of evolve? What happened next in our financial journey?
Well, MPT, it gave rise to what became known as the 60-40 portfolio. This strategy, it became like a benchmark, especially for long-term investing and retirement planning and all that.
Okay, 60-40 portfolio. So that's the 60% stocks, 40% bonds, right? Why did this specific allocation become so popular?
That's a good question. Stocks, historically, they've offered a higher growth potential over the long term, but they also come with they come with higher risk, right? Their value, it can fluctuate pretty dramatically in the short term. Bonds, on the other hand, they're generally more stable. They offer lower returns, but with less risk. So the 60-40 split, it was seen as a good balance, especially for investors with a longer time horizon, like those saving for retirement.
It's kind of like it's like finding that sweet spot between playing it safe and reaching for those higher returns. But what about when both stocks and bonds are struggling? Didn't that happen? Wasn't that in the 1970s? Does the 60-40 portfolio, does it hold up in those kind of situations?
You're right. The 1970s, they were a pretty turbulent time for the market, and the traditional 60-40 portfolio, it didn't perform as well as people expected, and that's where things start to get even more interesting. The limitations of the 60-40, it kind of led to some innovative, outside the box thinking about asset allocation.
This is where we start to see some alternative approaches, right? Who stepped up to offer a different perspective.
Well, that would be Harry Brown, a financial thinker who wasn't afraid to kind of challenge the status quo. In 1977, he introduced something called the permanent portfolio, and it's a fascinating approach that actually echoes some of the ideas from the Talmud. Remember how the Talmud, it talked about dividing wealth into three parts. Well, Brown, he kind of expanded on that, right, and incorporating four key asset classes.
Okay, I'm intrigued. What are the four pillars of this permanent portfolio?
It's divided equally, 25% stocks, 25% long-term treasury bonds, 25% gold, and 25% cash or money market funds.
Wow, that's a that's a pretty diverse mix. What was the rationale behind those choices?
Brown was all about preparing for different different economic scenarios, kind of like a chess player, thinking several moves ahead. He designed each asset class to perform well in a specific economic environment.
So it's like having a financial toolkit, right?
Yep.
Ready for anything the market throws at you.
Exactly. He saw stocks as a good bet during times of prosperity, economic growth, right?
Right.
While long-term treasury bonds, he thought those were meant to thrive during deflation.
And what about gold? Wasn't gold a strong performer back in the 1970s? That period that really kind of challenged the traditional 60-40 portfolio.
You're right. Brown, he believed that gold was a hedge against inflation, which was a big concern back then. And finally, cash. Well, cash is king, right?
Yeah.
When nothing else seems to be working, it provides flexibility and stability during those uncertain times.
So each asset class kind of has its own superpower, right?
Yeah.
Ready to activate when the economic conditions call for it. But I have a feeling there's more to this story. Did Brown's permanent portfolio did it stand the test of time?
Well, while it was a really brilliant step forward, like any pioneering concept, it did have its limitations. But that's a conversation for part 2 of our deep dive.
Can't wait to hear about those limitations and what happened next in this financial saga. Stay tuned, listeners. Things are about to get even more interesting. So last time we were talking about this permanent portfolio, right? The one Harry Brown came up with, designed to kind of handle any kind of economic storm. But you mentioned it had some limitations. What were those?
Yeah, you're right. No investment strategy is going to be perfect. One of the issues with Brown's approach was the way the assets were divided. Remember, it was 25%, 25%, 25%, 25%, stocks, bonds, gold, and cash.
Right. Yeah, it seemed pretty straightforward. What was the problem with that?
Well, you see, each asset class, they have different levels of volatility, how much their value goes up and down.
So even though the portfolio was diversified, some parts were inherently riskier.
Exactly. Gold, for example. Gold can be really volatile. The price can swing, wildly. And since Brown's portfolio, it gave equal weight to gold and bonds, which are usually more stable, the whole portfolio could be more sensitive to those gold fluctuations.
So it's kind of like putting together a team of superheroes, but one of them has a really unpredictable, streak.
I like that. That's a great analogy. Another limitation was that Brown's approach, it didn't always take into account how complex economic conditions really are.
What do you mean by that? Can you give me an example?
Sure. So Brown, he considered gold to be the hedge against inflation, right? But history shows us that gold, it doesn't always act the way you'd expect when prices are going up.
So it's not a guaranteed inflation buster.
Not necessarily. There have been times when inflation was high and stocks actually did better than gold. It all depends on the specific things happening in the economy.
Mm-hmm. It sounds like Brown was on the right track with diversification, but his formula, it needed a little tweaking, right, to address those issues.
Exactly, and that's where things get even more interesting. Those limitations, they sparked a whole new wave of innovation in asset allocation. Remember how Brown, he was trying to predict the future of the economy to position the portfolio?
Yeah, he was trying to figure out which economic scenario was going to happen, and then invest accordingly.
Right. Well, the next evolution, it gets even more sophisticated. In the 1990s, an approach called risk parity came about.
Risk parity. That sounds pretty intense. I'm guessing this strategy, it has a different way of allocating assets, right? What's the main idea behind it?
Okay, so imagine you're building a house. You wouldn't want one wall to be super strong while the other walls are, weak, right? You'd want the whole structure to be balanced, sturdy.
Right. Otherwise, the whole thing could collapse if there's too much pressure.
That's exactly the idea behind risk parity. Instead of just, dividing up assets by percentages or, economic predictions, it tries to balance the risk contribution of each asset class.
So it's not just about how much you invest in something, but also how much risk that investment brings to the whole portfolio.
Exactly. The goal is to create a portfolio where each asset class it contributes roughly the same amount of risk. That way, no single investment has a huge impact on how the overall portfolio performs.
It's like a really carefully planned dance, right?
Mhm.
With each asset class moving together to create a balanced and harmonious portfolio.
That's a great image, and here's where it gets even more interesting. Risk parity. It often uses something called leverage.
Leverage. Now that's a word that can make some investors pretty nervous. Can you explain what that means in this context?
Sure. So leverage is basically it's using borrowed money to potentially increase your returns. It's kind of like using a lever to lift a heavy object. You can move more weight with less effort.
But I imagine there's a trade-off, right?
Yep.
More potential for reward, but also more potential for risk.
You got it. Leverage, it magnifies both gains and losses. So while it can potentially boost your returns in a risk parity portfolio, it also requires, careful management and a deep understanding of the risks involved.
So this isn't really a strategy for someone who's, just starting out with investing.
Definitely not. Risk parity, with its focus on balancing risk and using leverage, it's a complex approach often used by institutional investors and hedge funds. But for everyday investors, the key takeaway here is it's the importance of understanding and managing risk.
Okay, that makes sense. As we've gone through, financial history, it seems like a few key themes keep coming up.
What themes are you thinking of?
Well, the importance of diversification, right?
Right.
Understanding your own personal risk tolerance, and being prepared to adapt as economic conditions change.
Mhm.
Whether we're talking about the ancient Talmud, modern portfolio theory, or these more sophisticated strategies like risk parity, those principles seem to be like the foundation of smart wealth allocation.
You're absolutely right. And speaking of changing economic conditions, are you ready to explore how these ideas apply in today's market?
Yeah, definitely. It feels like the financial landscape right now is anything but calm. It'd be great to get your take on what investors should be thinking about in this current environment.
All right, let's shift gears and talk about the challenges and opportunities facing investors today.
So we've talked about a lot, right? From like ancient wisdom to these really complex modern investing strategies. It's really fascinating stuff, but I think our listeners are probably wondering, like, how does it apply to my money, right now?
Right, yeah, that's the big question, isn't it? And honestly, the economic climate right now, it's pretty wild out there.
Yeah, I mean, it feels like, 1 minute the market's calm, the next it's like a total roller coaster. We've got, inflation going up, interest rates, geopolitical stuff. It can feel kind of overwhelming to even like think about investing.
You're not wrong. There's a lot to think about these days. I think the biggest challenge for most people is just it's that feeling of uncertainty.
Yeah.
Like, it's hard to predict what's going to happen next, which makes it really hard to know how to position your portfolio.
It's like trying to hit a moving target, right, in a dark room. So how do we deal with all this uncertainty without making like rash decisions?
Well, I definitely wouldn't recommend, throwing darts at a stock board or anything. The key is to have a solid financial plan, right? Knowing your goals, what you're comfortable with in terms of risk, and your time horizon. That can really help you stay grounded when things get crazy in the market.
So it's like having a roadmap and a compass,
Yeah.
right? Even when the path gets a little rough.
Exactly. A good plan helps you stay on course even when things get bumpy. And the other really important thing is to remember those timeless principles we've been talking about, right? Diversification, managing risk, and staying informed.
But diversification, I mean, it probably looks a lot different today than it did, back in like Talmudic times, right?
Yeah.
It's not just about land and businesses and cash anymore.
You're absolutely right. Today's investors, they've got a much wider range of things to choose from. You've got real estate, commodities, private equity, even digital assets like cryptocurrencies.
Wow, it's like the investment menu has just totally exploded. But that also makes things It makes things more complicated, doesn't it?
It does, yeah. And that's why it's more important now than ever to have a really clear understanding of your own personal financial goals, how much risk you're comfortable with, all of that. There are so many options out there. And finding that right mix, the one that really aligns with your specific needs, that can be a real challenge. And remember, investing, it's a marathon, not a sprint, right? The important thing is to stay informed, stay diversified, and stay focused on your long-term goals. Don't let those short-term ups and downs in the market, don't let them derail your overall plan.
That's a great reminder. I think we've covered a lot today, from ancient wisdom to modern portfolio theory and everything in between. But if there's one thing I hope our listeners take away from this deep dive, it's that timeless truth. Smart investing. It's about understanding the principles, adapting to those changing conditions, and having a plan.
Well said.
Thanks for joining us on this deep dive. Until next time, everyone, happy investing.
Next off, we have episode 5.
Welcome back, everybody. Today, we're going to be taking a deep dive into risk parity.
Okay, sounds good.
So, you always hear people talking about this traditional 60-40 portfolio.
Right.
So 60% stocks, 40% bonds. But risk parity kind of flips that on its head and says, well, instead of looking at, the dollar amounts, what if we balanced it out based on the risk of each asset?
Exactly.
And, instead of having stocks dominate the risk profile of your portfolio, each asset class would then be contributing equally to the overall risk.
And that's a really key distinction because, like you said, a traditional 60-40 portfolio sounds balanced on the surface.
Right.
But in reality, stocks are much more volatile.
Yeah.
So your portfolio is really heavily exposed to stocks in that scenario.
Yeah.
So risk parity tries to smooth that out.
Yeah. So we're aiming for equal risk contribution from each asset class, but how do we actually do that?
Right.
One of the sources that we're looking at today is the All-Weather Strategy document from Bridgewater Associates.
Okay.
And they suggest using leverage to adjust the risk profile of different assets.
Mm-hmm.
Now, I know leverage is a scary word for some investors.
Sure.
But stick with us here.
Leverage is actually a very simple concept when you boil it down.
Okay.
So essentially, leverage magnifies both the potential gains and the potential losses.
Right.
So you can use it to make a traditionally, quote-unquote, safer asset like bonds behave more like a riskier asset like stocks.
So the All-Weather Strategy document gives a pretty good example of that. It compares the historical performance of the S&P 500, a U.S. 10-year bond, and a leveraged U.S. 10-year bond.
Right.
And get this, when leveraged appropriately, the bond actually achieved similar risk and return characteristics as the S&P 500.
Yeah, which I know that can seem counterintuitive at first because you think of bonds as being low risk and stocks as being high risk.
Oh, right.
But by using leverage, you can adjust those risk profiles to create a more balanced portfolio.
Now, this brings up an interesting point that was mentioned in the CFA Institute chapter, and that's leverage aversion.
Mm-hmm.
So the idea is that the market might have an irrational fear of leverage, meaning that these safer leveraged assets could potentially be undervalued.
Interesting.
And offer higher returns for, savvy investors.
That's one theory, and it's an important one.
Yeah.
That raises a crucial question. Is this aversion to leverage a genuine market inefficiency?
Right.
Or are there hidden risks the market is pricing in?
Right.
And I think this ties into a core belief of risk parity, and that is focusing on the relationship of asset classes to the broader economic environment.
Okay, so instead of just looking at how assets correlate with each other, we're considering how they behave in different economic scenarios.
Exactly.
So Bridgewater identifies these 4 key environments: rising growth, falling growth, rising inflation, and falling inflation.
Right.
And they design their all-weather portfolio to hold up well in all those different climates.
That's right. And if you look at the table that's provided in their document, it's quite insightful. You can see how different asset classes tend to perform in each environment.
Right.
Really highlights the importance of diversification.
So imagine you're building your own all-weather portfolio, just like Bridgewater did back in the day.
Okay.
And they started with a simple program like Microsoft Excel to analyze these relationships.
Right.
Which I think that to me, that highlights the accessibility of risk parity principles.
Yeah.
You don't need fancy algorithms or Wall Street connections.
Right.
Really grasp the core concept here.
Exactly.
And remember, one of the key goals of risk parity is to achieve a higher Sharpe ratio.
Right.
Now, the Sharpe ratio measures risk-adjusted return.
Exactly.
So a higher Sharpe ratio means you're getting more return for each unit of risk that you're taking.
That's right.
And the simulations that they showed in the all-weather strategy document showed that their risk parity portfolio achieved a significantly higher Sharpe ratio compared to a conventional portfolio.
Yes.
And let's not forget the potential for reduced volatility.
Absolutely.
According to the Risk Parity Radio episode, for a given return target, a risk parity portfolio could be up to 60% less volatile than a traditional portfolio.
Yeah, that's huge.
Think about what that means for you.
Yeah.
Potentially achieving similar returns with way fewer ups and downs.
Right.
That smoother ride can make a big difference, especially for long-term investors that, might get a little bit, unnerved by big market swings.
Sure.
But it's important to remember that risk parity isn't a one-size-fits-all solution.
Right.
There are actually different types of risk parity strategies out there.
That's right.
Some are more conservative, some are more aggressive.
Right.
We'll get into all that a little bit later on.
Sounds good.
So we've established there are different flavors of risk parity out there, from conservative to aggressive.
Right.
But before we dive into that, I want to circle back to Bridgewater and their all-weather approach.
Yeah.
Because it's really fascinating how they even arrived at this concept.
Right.
Their journey, as described in the all-weather story, it's a great example of how thinking outside the box can lead to these really innovative investment strategies.
Absolutely.
And it's really interesting because, they weren't trying to predict the next hot stock or time the market perfectly or anything like that.
Yeah.
They really started with this fundamental question of what kind of portfolio would thrive in any economic environment?
Exactly.
And that focus on resilience, on weathering any storm, I think is really what sets risk parity apart from those traditional approaches.
I agree. It's about thriving, not just surviving.
Right, exactly. And so the Risk Parity Radio episode mentions that, it all started with a question from a pension fund manager about using long-duration, zero-coupon bonds.
Okay.
Now, at the time, most institutional portfolios were heavily tilted towards equities,
Right.
which left them really vulnerable to these economic contractions, especially deflationary ones like we saw during the Great Depression.
Right.
And Bridgewater recognized that.
They did.
They understood that equities perform poorly in certain economic conditions.
Right.
So they were trying to find an asset class that would act as this counterbalance.
Exactly.
Something that would rise when equities fell.
Right.
And they found that long-duration bonds fit that bill perfectly.
Yes.
And it's amazing to me they were using just simple Microsoft Excel, a program that a lot of us probably use every day,
Yeah.
to analyze this concept.
Right.
They created these 4 different portfolios, each designed to perform well in a specific economic environment. So you've got rising inflation, rising growth, falling growth.
Right.
And by combining those portfolios, they created this diversified approach
Yeah.
that wasn't reliant on accurately predicting which environment would prevail.
Exactly.
It's like building a house with reinforcements for, earthquakes and floods and hurricanes all at the same time.
I love that analogy.
Yeah.
It's really good.
You're prepared for anything, even if you don't know what specific challenge might come your way.
That's right.
But even with this robust approach, Bridgewater still faced challenges.
Yeah.
The all-weather story recounts how their depression gauge went haywire during the 2008 financial crisis.
That's right.
Now, they had developed this depression gauge as a warning system.
Yes.
It was supposed to signal when things were getting too risky, even for their, balanced portfolio, like
Right.
all weather.
Right.
And so when Lehman Brothers collapsed, the gauge sounded the alarm, signaling a very high probability of this, depression-like scenario.
So what did they do?
So they essentially battened down the hatches,
Right.
and they took shelter in their safe portfolio.
Okay.
And that portfolio was specifically designed to preserve capital during these extreme market turmoil.
So the safe portfolio was all about minimizing risk.
Right.
So market risk, credit risk, counterparty risk.
Yep.
While remaining neutral to both inflation and deflation.
Exactly.
And to achieve this, they used a combination of hedged global government bonds, both nominal and inflation indexed,
Okay.
government bills, and gold.
Wow. So they rode out the storm in their safe portfolio and then gradually shifted back to the all-weather mix as markets stabilized.
Right.
And this just to me, this highlights the importance of adaptability. Having a plan for different scenarios and knowing when to adjust your approach.
Exactly.
But, reading about how they navigated that crisis, it almost felt like, their actions blurred the lines between risk parity and like macro hedge fund investing.
That's a really good observation.
Yeah.
And I think you're right. The principles behind risk parity have definitely influenced the world of macro hedge funds.
Right.
Particularly the emphasis on economic environments and the use of leverage.
Right.
And as we mentioned before, many risk parity strategies have actually become more dynamic over time.
Yeah.
Adapting to changing market conditions.
And that evolution has really led to like a huge increase in the popularity of risk parity.
Yes.
The CFA Institute chapter points out that the number of firms offering risk parity products has exploded in recent years.
Right.
And that assets under management using these strategies has grown considerably as well.
It's a testament to the growing acceptance of risk parity's potential benefits.
Right.
But this rapid growth has also resulted in a wide range of products with varying approaches.
Right.
Some are more conservative, some are more aggressive.
Right.
So it's not a monolithic concept anymore.
Yeah. The Risk Parity Radio episode highlights that diversity of approaches, and Exhibit 4.13 in the CFA Institute chapter really drives that point home.
Yeah.
It compares the returns of various risk parity products over a 3-year period, and the differences are stark.
Yeah.
So it's clear that not all risk parity products are created equal.
Exactly.
And understanding the specific approach and risk level of any product that you're considering is absolutely crucial.
It is. Risk parity is more of a framework than a rigid formula.
Right.
Different managers can implement it in very different ways.
Right.
Which is why due diligence is paramount.
Right.
When selecting a risk parity strategy.
Yeah.
You need to understand the manager's investment process, their risk management framework, their track record.
It's about aligning yourself with a manager whose philosophy and approach resonates with your own, investment beliefs and risk tolerance.
Exactly.
But even with all this surge in popularity, risk parity isn't without its critics.
Right.
Particularly when it comes to the use of leverage. The CFA Institute chapter addresses this concern directly.
Yeah.
Highlighting the potential risks associated with leverage, especially on fixed income during periods of rising interest rates.
Yeah, leverage by its very nature amplifies both gains and losses.
Right. And we've seen real-world examples of this play out.
We have.
Remember the San Diego County Employees Retirement Association, or SDCERA?
I do.
They adopted this risk parity approach.
Right.
But ultimately, they abandoned it after underperforming during a bull market.
Right.
So this kind of leaves us with this big question: is risk parity a miracle solution?
Right.
A step too far?
Or something in between.
Or something in between, yeah.
Yeah.
There's no easy answer.
No.
The performance of risk parity can be heavily influenced by, factors like interest rates and the overall economic environment.
Sure.
Having delved into all this research, I'm kind of leaning towards the idea that risk parity is more of a philosophy than a specific strategy.
I agree.
It's just a different way of thinking about portfolio construction.
Right. One that emphasizes diversification and balance above all else.
And it challenges conventional wisdom about asset allocation.
Right.
Encourages investors to look beyond traditional approaches.
And while leverage is a key element of risk parity,
Yeah.
it's also the source of much debate and requires careful consideration.
It does.
The Risk Parity Radio episode brought up this really interesting statistic.
Yeah.
That the overall performance of a portfolio is about 94% determined by the overall macro asset mix.
Wow.
Which is just a powerful reminder that asset allocation is king.
Yes, it is.
And risk parity offers a unique and potentially very effective approach to building that truly diversified portfolio.
I think so too.
Okay, so we've explored the philosophy behind risk parity, some of the potential advantages and some of the key considerations.
Right.
Now let's get practical.
Okay.
How do you actually implement a risk parity strategy?
Yeah, that's the question on everybody's mind, right?
Yeah.
Well, the first decision point is how hands-on do you want to be? Yeah.
Do you want to build and manage your own risk parity portfolio?
Right.
Or would you rather outsource it to a professional manager?
Okay, so let's start with the DIY approach.
Okay.
So if you enjoy the challenge of investing and you have a pretty good grasp of, the concepts that we've been discussing,
Right.
building your own portfolio can be incredibly rewarding.
It can.
And you don't need any sophisticated software, remember.
No.
Bridgewater started with just simple Microsoft Excel.
Right.
So that really speaks to the accessibility of this approach.
It does.
Okay, so for those who want to venture into, the DIY risk parity, what are some of the key steps involved?
Okay, so first you need to select your asset classes.
Right.
Most risk parity portfolios include a mix of stocks, bonds, and commodities.
Mm-hmm.
But you can certainly incorporate other asset classes as well,
Right.
like real estate or precious metals.
The all-weather strategy document provides a really good framework for thinking about asset allocation. It groups asset classes based on their performance in those different economic environments. Mm-hmm. So it's a fantastic starting point for constructing your own portfolio.
It is.
The Risk Parity Radio episode emphasized the importance of considering your safe withdrawal rate, especially if you're planning to, live off your investments in retirement.
Right.
A risk parity portfolio with lower volatility could potentially support a higher safe withdrawal rate compared to a traditional portfolio.
It could.
So that could give you more financial security during those retirement years. Now, once you've established your asset allocation, you're going to need to rebalance your portfolio regularly.
Right.
To maintain that desired risk profile.
That's right.
And this means, buying or selling assets as their prices fluctuate to ensure that each asset class continues to contribute its intended share of risk.
Right. And that's where discipline really comes in.
Yeah.
Because it's easy to get emotional, when markets are swinging wildly.
Oh, yeah.
And deviate from your plan. But sticking to your rebalancing strategy is absolutely essential for long-term success.
Absolutely. Well, I think that about covers it.
Yeah, I think so.
A comprehensive overview of, some of the practical considerations for implementing risk parity.
Mm-hmm.
We hope this deep dive is giving you the knowledge and the confidence to make those informed decisions.
I hope so, too.
Risk parity, like any investment approach, has its nuances and considerations.
Of course.
It's not a one-size-fits-all solution.
No, it's not.
But by understanding the principles behind risk parity,
right,
the potential benefits and drawbacks, and the key factors for implementation, you can build a portfolio that truly aligns with your unique needs and aspirations.
Absolutely.
So keep learning, keep exploring, and never stop challenging that conventional wisdom.
Words to live by.
Who knows what innovative investment approaches the future holds?
Yeah, that's the exciting part. The world of investing is always evolving.
Yeah, that's right. And we're thrilled to be your guides on this fascinating journey.
Me too.
Thanks for joining us on this deep dive into risk parity.
Yes, thank you.
We hope you found it valuable and insightful.
Next off, we have episode 7.
Welcome to the deep dive. Today, we're going to unpack something called risk parity portfolios.
Okay.
It's this way of investing that kind of shifts your focus from just returns to really strategically managing risk.
Yeah.
We've got a great YouTube video from Risk Parity Radio, which explains it all and offers some practical tips, plus a summary document with some helpful links.
Great. So get ready to change how you
think about building your portfolio.
Yeah, for sure.
Okay, so let's dive right in with something that's been puzzling me.
Okay.
I've heard that these fancy, professionally managed risk parity portfolios have a bit of a mixed track record.
Right.
Some did amazingly well during market downturns, like March 2020 only dropping 17 to 20%.
Okay.
But others tanked over 40%.
Yeah.
Why such a huge difference?
That's a great question.
Yeah.
The Risk Parity Radio video touched on this too.
Okay.
A lot of these professional strategies get super complicated.
Oh, really?
Like juggling 15, 20 different asset classes.
15 to 20?
Yeah.
That's way more than I could handle.
Right. And it doesn't stop there.
Oh, no.
They also get into these complicated derivatives like futures and options, which can really backfire.
Oh.
Remember Wealthfront's Risk Parity product?
Mm-hmm.
They took a big hit in March 2020, apparently, because of those kinds of strategies.
Oh, wow.
Yeah.
So that's a relief.
Yeah.
Our deep dive today focuses on the DIY approach.
Exactly.
Something that's actually understandable and manageable, right?
Absolutely. We're going to break down how to build a risk parity portfolio you can actually control.
Perfect.
Yeah.
Now, the video laid out 3 key principles for DIY risk parity.
Okay.
Almost like a treasure map.
Right.
The holy grail, macro allocation,
Okay.
and simplicity.
Right.
Can you break those down for us?
Think of the Holy Grail principle, as Ray Dalio calls it,
Okay.
as the foundation of risk parity.
Okay.
It's all about finding assets that zig when others zag, having low or even negative correlation. By combining those, you reduce your risk without necessarily sacrificing returns.
So instead of putting all our eggs in one basket
Right.
and hoping for the best, we're spreading them out strategically.
Exactly. And then there's the macro allocation principle.
Okay.
The idea here is that over 90% of your portfolio's performance
Wow.
comes down to how you spread your money across the major asset classes.
Okay.
Stocks, bonds, gold, things like that.
Gotcha.
Picking individual stocks matters less than getting this big picture right.
So it's like choosing the right recipe, then tweaking the seasonings later on.
That's a great way to put it.
Okay.
Finally, there's the simplicity principle.
Okay.
As Rick Ferry said,
Mhm.
complexity is a cost. Simplicity is an alpha.
Right.
Too much complexity leads to mistakes
Yeah,
and makes it harder to manage your portfolio effectively.
for sure.
Keep it simple and avoid those impulsive decisions.
Now, you mention these uncorrelated assets.
Yes.
Where do we even find these magical investments?
We'll get into specifics later, but a good tool to start with is a correlation analyzer.
Okay.
There are free ones online, like the one on Portfolio Visualizer.
Awesome.
You can compare different funds and see how their prices have historically moved in relation to each other.
And that's where we see those correlation coefficients, right?
Exactly.
Those numbers from -1 to +1.
A correlation of +1 means two assets move perfectly in sync,
Okay.
like a pair of synchronized swimmers.
Got it.
A correlation of 0 means they move independently, and -1 means they move in opposite directions.
Okay.
That's what we're aiming for,
Yeah.
finding those assets that will balance each other out.
So where do typical assets fall on that spectrum?
Well, think about stocks.
Okay.
Most stocks tend to be highly correlated.
Mm-hmm.
They move up and down together.
Makes sense.
That makes sense because they're all influenced by similar economic factors.
Right.
But then you have long-term treasury bonds.
Okay.
They often have a negative correlation with stocks, which means when stocks go down, bonds might actually go up.
Interesting. So bonds act like a cushion when the stock market gets bumpy.
Precisely.
Mm-hmm.
Then you have gold and commodities,
Okay.
which tend to be uncorrelated with both stocks and bonds.
Oh,
They're kind of the wild cards marching to the beat of their own drum.
gotcha.
Finally, you have things like REITs and preferred shares,
Okay.
which tend to be slightly correlated with stocks,
Okay.
offering some diversification, but not as much as those negatively correlated assets.
Okay. I'm starting to see the bigger picture here.
Yeah.
But how do we actually start putting these pieces together?
A solid starting point is to build a foundation with those negatively correlated assets we talked about, stocks and long-term treasury bonds.
Right.
They form the core of most risk parity portfolios,
Uh-huh.
balancing growth potential with stability.
Okay.
Think of stocks as the engine of your portfolio and bonds as the brakes,
Okay.
each playing a distinct role in managing risk.
So we have our engine and our brakes. What else can we add to the mix?
You can then layer in those uncorrelated assets,
Okay.
like gold, commodities, preferred shares, REITs,
Mhm.
even some cash or short-term bonds,
Okay.
in proportions that align with your risk tolerance and goals.
Gotcha.
The Risk Parity Radio video has some sample portfolios to get you started.
So once we've got a portfolio structure in mind, what's the next step? It sounds like we need to take it for a test drive before putting real money down, right?
Exactly. We have these great free online tools like Portfolio Charts
Oh, cool.
and Portfolio Visualizer
Okay.
that let you backtest your portfolio and even run Monte Carlo simulations.
So we can see how it would have performed in the past
Yeah.
and under different market conditions. That's like a virtual crash test for our portfolio.
You got it. And remember, the most important metric for a retirement portfolio is the projected safe withdrawal rate,
Okay.
how much you can withdraw each year without running out of money.
Ah, that makes sense. I've heard about the 4% rule.
Right.
Is that still relevant for these kinds of portfolios?
That's the traditional guideline for a standard stock and bond portfolio. But the beauty of risk parity is that it often leads to a much higher safe withdrawal rate,
Really?
sometimes 5-6% or even more.
Wow, that could make a huge difference in retirement planning.
Huge.
So instead of just assuming a 4% withdrawal rate, we could potentially retire earlier
Yeah,
or have more flexibility in our spending.
exactly. It really changes the game and highlights how a strategic approach to risk can have a huge impact on your financial well-being.
Yeah.
It's not just about returns.
No.
It's about understanding how much risk you're comfortable with
Right.
and building a portfolio that can weather those market storms.
This is making me rethink my own retirement plans.
I know, it's exciting.
So what are some practical first steps for someone who wants to explore building their own risk parity portfolio?
We'll start by revisiting those 3 key principles we discussed.
Okay.
The holy grail, macro allocation, and simplicity.
Right. Those are the foundation of our portfolio house.
Exactly.
And then you mentioned those online tools, Portfolio Visualizer and Portfolio Charts.
Yeah.
Are those good places to start experimenting?
Absolutely. They're treasure troves of information.
Cool.
And you can play around with different asset combinations and see how they behave.
Awesome.
It's like a virtual sandbox for portfolio building.
That sounds fun.
Yeah, it is.
So it seems like there's a lot of flexibility in this approach. It's not just a one-size-fits-all solution, right?
Exactly. You can tailor it to your specific risk tolerance, financial goals, and time horizon.
Okay.
There's no right or wrong answer.
Okay.
It's all about finding a balance that you're comfortable with.
Gotcha.
Don't be afraid to experiment.
Yeah.
Start with a simple portfolio. Test it out using those online tools. See how it performs under different scenarios, and then adjust as needed.
Okay.
It's a journey of learning and fine-tuning.
And those sample portfolios from the Risk Parity radio video can be really helpful as a starting point, right?
They are a fantastic resource, showing that you don't need to reinvent the wheel.
Right.
You can learn from others who have paved the way.
Now, speaking of those sample portfolios, you mentioned earlier that long-term treasury bonds play a key role in most of them.
Yeah.
I'm curious, why are they so important?
Well, remember, we're looking for those negatively correlated assets.
Right.
And long-term treasury bonds often fit the bill. They've historically moved in the opposite direction of stocks.
Okay.
Which makes them incredibly valuable for smoothing out the bumps in the road.
So even though they might not grow as fast as stocks, they're like shock absorbers for the portfolio.
Exactly. The video also points out that the exact mix of stocks and bonds will vary depending on your other assets and your risk tolerance.
Gotcha.
It's not always a simple 50-50 split.
That's important to remember. It's all about finding that sweet spot between risk and return.
Yes.
That aligns with your personal circumstances.
The video also emphasized that while professional risk parity portfolios can get incredibly complex, the DIY approach can be surprisingly simple.
Yeah.
You can often achieve it with just a handful of carefully selected ETFs.
That's good to know. It's reassuring to hear that you don't need to be a financial wizard to build a solid risk parity portfolio.
Nope, not at all.
So let's talk about some of those other asset classes that might find their way into the mix.
Right.
Gold seems to be a popular one.
Yeah.
I'm curious, what role does gold play in a risk parity portfolio?
Gold often gets included because it tends to be uncorrelated with both stocks and bonds.
Okay.
It's seen as a potential safe haven asset, something that can hold its value when the economy gets shaky.
So it's like having an insurance policy in your portfolio.
Yeah.
Not necessarily for growth, but for protection.
That's a great analogy. It's not about getting rich quick with gold.
Right.
It's about adding a layer of stability to the portfolio during turbulent times.
What about commodities? We haven't talked much about those.
Right. Well, the video mentioned commodities like oil, natural gas, agricultural products as potentially good additions to a risk parity portfolio.
Okay.
They also tend to have low or negative correlations with stocks and bonds.
Interesting.
And can act as an inflation hedge.
Okay.
Helping to protect your purchasing power when prices start rising.
So they're like a buffer against inflation.
Exactly.
I remember during the pandemic, commodities were one of the few things that held their value or even went up.
That's right. They can be a valuable tool for diversification, especially when inflation is a concern.
Now, something else that stood out to me in the video was the importance of regularly rebalancing the portfolio.
Yes.
Can you explain why that's so crucial for risk parity?
Rebalancing is essential for a couple of reasons.
Okay.
First, it forces you to buy low and sell high.
Okay.
When one asset class outperforms the others, its proportion within your portfolio naturally increases. Rebalancing means selling some of that overperforming asset and buying more of the underperforming ones.
So you're essentially locking in some profits from the winners and buying the relative bargains.
Exactly.
Makes sense. But what's the second reason?
The second reason is that rebalancing helps you maintain your desired risk level.
Okay.
As asset prices go up and down, your portfolio's risk profile can drift away from your original target.
So if stocks have a great year, your portfolio might become unintentionally more aggressive than you planned.
Exactly. Rebalancing brings it back into alignment with your risk tolerance.
Okay. The video mentioned that backtesting and Monte Carlo simulations can help you figure out how often to rebalance.
Yeah.
Do you have any thoughts on that?
Those tools can be incredibly helpful in determining the optimal rebalancing frequency for your specific portfolio.
Okay.
Some portfolios may benefit from quarterly rebalancing,
Mm-hmm.
while others might be better off with an annual approach.
Okay.
It really depends on the assets you've chosen and how volatile they are.
So it's finding that sweet spot between not rebalancing too often and incurring extra trading costs,
Right.
but also not letting your portfolio drift too far from its target.
Exactly. It's all about finding that balance between discipline and efficiency.
Now we've got our portfolio built and we're rebalancing it.
Yep.
What else should we be thinking about as we manage our risk parity portfolio over time?
One thing that always comes to mind for me is expenses.
Yeah.
Every dollar we pay in fees eats into our returns.
Right.
I'm assuming that's still something to watch out for with risk parity, right?
Absolutely. Expenses are a silent killer of returns.
Yes, they are.
When choosing ETFs or other investments for your portfolio,
Mm-hmm.
pay close attention to their expense ratios.
Right.
The lower, the better.
But it's not just about finding the absolute lowest fees, is it?
Right. What about the quality of the fund?
You're right. It's not just about chasing the cheapest option.
Okay.
Sometimes paying a slightly higher expense ratio for a well-managed fund with a solid track record can be worth it in the long run.
That makes sense.
It's about finding the right balance between cost and quality,
Right.
getting the most value for your investment dollar.
Mm-hmm.
What about taxes?
Oh, yeah.
Those can have a big impact on returns too, right?
They absolutely can. So should we be thinking about taxes when building and managing a risk parity portfolio?
Absolutely. Taxes can significantly impact your overall returns.
Yeah.
So it's essential to consider tax efficiency when making investment decisions.
Okay.
Tax-advantaged accounts like IRAs and 401ks are great places to hold these investments.
Yeah. And for investments held in regular taxable accounts?
Consider ETFs known for their tax efficiency.
Okay.
They're structured to minimize taxable distributions,
Okay.
allowing you to keep more of your investment gains.
So it's not just about picking the right investments.
Right.
It's also about holding them in the right types of accounts to minimize taxes.
That's right. It's all about optimizing your portfolio from every angle.
Okay, so we've covered a lot of ground here.
Yeah.
The principles of risk parity,
Mm-hmm.
the different asset classes, rebalancing, and even tax efficiency.
Mm-hmm.
I feel like I have a much better grasp on this approach now.
Me too.
But it's a lot to take in.
It is.
It's reassuring to know that this is just the beginning of the journey,
Yeah,
and there's always more to learn.
absolutely.
It is a lifelong journey of learning when it comes to investing.
It definitely is. And the more you understand, the better decisions you'll make to reach your financial goals.
Mm-hmm.
You know, going back to the Risk Parity radio video,
Yeah.
one of the things that really struck me
Okay.
was how this approach could completely change how we think about retirement planning.
Yes, that part was eye-opening. The video talked about how these portfolios, with their potential for higher safe withdrawal rates,
Right?
could really shift our retirement timelines.
Yeah, for sure.
It made me wonder if instead of relying on that traditional 4% rule, what could a 5-6% withdrawal rate or even higher
Yeah.
mean for our listeners?
It's a huge difference. Think about it.
Yeah.
Retiring earlier, having more financial freedom to travel or pursue hobbies, or just feeling more secure knowing your savings can last longer. It changes the whole picture.
It's not just about numbers on a spreadsheet anymore. It's
Right.
about the freedom to live the life you want.
Exactly.
It really highlights how powerful this concept of risk parity can be.
Absolutely. It's about being proactive,
Yeah.
understanding your options, and choosing the approach that aligns with your goals and values.
Taking control of your financial future.
Yes.
So as we wrap up our deep dive into risk parity portfolios,
Okay.
what's the one big takeaway you hope our listeners will remember?
I hope they'll remember that investing isn't just about chasing returns.
Right.
It's about managing risk
Uh-huh.
by diversifying wisely,
Okay.
understanding how different assets relate to each other, and focusing on the long term.
Yeah.
They can build a portfolio that can weather any market storm and help them achieve their financial dreams.
That's a great way to put it. And before we sign off, I want to leave our listeners with one final thought to consider.
Okay.
If risk parity can potentially boost those safe withdrawal rates so significantly,
Yeah.
what could that mean for your retirement plans?
Oh, yeah?
Could you retire earlier,
Uh-huh.
travel more,
Yeah.
finally pursue that passion project you've been dreaming of.
The possibilities are truly exciting, and that's the power of knowledge and informed decision-making.
Thank you for joining us on this deep dive into risk parity portfolios. We hope you've gained some valuable insights and are feeling inspired to take control of your financial future.
It's been a pleasure exploring this topic with you.
Until next time, keep exploring, keep learning, and keep diving deep.
Last off,
we have episode 9.
All right, so you guys have sent in a ton of stuff on preferred shares, and you really want to know if they belong in your portfolio.
Yeah.
So we are going to dive deep and help you figure that out.
Absolutely.
They're this hybrid between a stock and a bond,
Right.
and a lot of people are talking about the income potential. So
Yeah, and that steady income stream is a big draw for a lot of people.
Mm-hmm.
But unlike bonds, they do have some price fluctuation,
Yeah.
Kind of similar to stocks.
Yeah.
So that's the unique thing about them.
So before we get into it, I just want to mention one funny thing from this YouTube source.
Okay.
Have you heard of the Bangladesh butter indicator?
I have not.
No. So apparently there's this weird correlation between the price of butter in Bangladesh and the S&P 500.
Wow.
So, I mean, it's funny, but it also shows that correlation doesn't mean causation.
Right, exactly. We
Doesn't
don't want to
matter.
make investment decisions based on random connections.
Right. And there's a lot of noise out there.
There is.
So how do we avoid falling into those traps? Bad advice.
Well, you're right. And that's why we need a good framework.
Right.
And I think, luckily, we have one. It's David Stein's 10 questions, and we're going to use these questions to really dissect this ETF PFF,
Okay.
which is one way to invest in preferred shares.
So just to clarify, this framework can be used with any investment.
With any investment, exactly. It's really helpful.
Awesome.
Yeah.
So one thing that this YouTube source mentioned was some bad investing strategies.
Oh, yeah.
And that's stuff like, following hot stock tips or trying to time the market.
Right.
Why is that so dangerous?
Well, I think a lot of it stems from emotional reactions
Yeah.
and not really understanding the risks involved in market dynamics.
Yeah.
So, for example, if a stock went up 20% last month,
Right.
that doesn't mean it's going to go up 20% this month.
Right.
It's just not how it works.
What about taking advice from someone who isn't a fiduciary?
Oh, yeah, that's a red flag.
Yeah.
You want to make sure that your advisor is a fiduciary.
Yeah.
That means that their interests are aligned with yours, and not an advisor who's just pushing products that benefit them.
Okay, so due diligence is key.
Absolutely.
Let's pivot back to David Stein's 10 questions.
Yeah.
So that's going to be our roadmap for evaluating PFF.
Exactly right. And it really helps us to just take a step back
Yeah.
and approach this systematically and objectively. And the first question, kind of deceptively simple, but so crucial, is what is it?
Right. So we're looking at PFF,
Yeah.
this ETF that's composed of preferred shares.
Uh-huh.
But this YouTube source called preferred shares, this hybrid between stocks and bonds, I'm still not sure I understand what that actually means.
So they occupy that middle ground. So just like bonds, they usually offer steady income through dividends, but like stocks, their prices can fluctuate.
Okay.
And in a bankruptcy, they would have a higher claim on assets than common stock, but lower than bonds.
Okay. I'm starting to get a clearer picture now.
Good.
Question 2 is investment, speculation, or gamble.
Yes.
So where does PFF fit in?
So based on Stein's definitions, PFF is squarely in the investment category.
Okay.
It generates income through dividends and historically has a positive expected return over the long term.
Right.
So we're not timing the market. We're not buying lottery tickets, hoping to hit the jackpot.
Right. So it's not gambling.
Not gambling.
Okay. That's reassuring. Now to the exciting part, potential upside.
Yeah.
What kind of returns can we expect with PFF?
So the primary upside of preferred shares,
Yeah.
and thus PFF, lies in that consistent dividend income. And currently, the yield is around 5.4% annually,
Wow.
which is significantly higher than a lot of traditional bond options available right now. But this does change over time,
Of course.
depending on interest rates and all these other things.
Okay. Yeah, that high yield definitely grabs my attention.
Yeah,
But of course, every investment has risks.
of course.
So question 4 is all about the downsides.
Yeah.
What are those?
So one major risk is interest rate sensitivity. So when interest rates rise, the value of fixed income investments, including preferred shares, tends to decrease.
Okay. So that's a risk with any fixed income product.
Right, exactly.
Yeah,
So that's something to keep in mind.
What other risks should we be aware of with preferred shares specifically?
Another one is company performance. So if a company that's issuing preferred shares experiences financial difficulties, they may reduce or even suspend dividend payments.
Oh, that makes sense.
However, PFF has over 500 different preferred shares.
Right.
So we're not overly exposed to any single company's troubles.
That's a big advantage.
It is.
Okay, so question 5 is, who's on the other side of the trade? What does that mean in terms of PFF?
So essentially, who are the big players who are buying and selling these preferred shares?
Yeah.
And the YouTube source really highlights institutions like pension funds and insurance companies.
Okay.
And they're looking for those steady income streams, which makes this market fairly stable and liquid.
So it's not just individual investors.
No, it's not.
All right. Question 6 focuses on the investment vehicle itself.
Okay.
So we know PFF is an ETF.
Right.
What makes that good for the average investor?
Think of an ETF like a basket of securities.
In this case, preferred shares. So you can buy and sell it just like a stock on an exchange, but you get that diversification benefit.
Right. So in the case of PFF, you're getting exposure to over 500 preferred shares.
Right. Exactly.
Which is great because I don't have the time or expertise to research all the individual shares.
Exactly. And ETFs generally have very low expense ratios.
Oh, that's great.
Yeah. So EFF specifically has a 0.46% expense ratio.
So for every $100, only 46 cents goes to fees?
That's right.
That's incredibly cost effective.
It is.
Now, question 7. What does it take to be successful with this investment? Is it a set it and forget it kind of thing?
It's pretty close to that.
Okay.
You buy the ETF, you collect dividends. Of course, it's wise to just monitor its performance periodically and, rebalance your portfolio.
Right.
But you're not going to be day trading or trying to time the market with this investment.
So it's a long-term strategy.
Exactly. It is, yeah. Okay. Question 8. Who's getting a cut? We talked about the low expense ratio, but are there any other hidden fees?
Besides the expense ratio, you might have trading commissions depending on your brokerage. But a lot of brokerages offer commission-free trades on ETFs now.
Okay. So you might be able to dodge those fees altogether.
You might be able to, yeah.
Now, question 9, how does PFF impact your overall portfolio? This is an interesting one.
It is.
Especially when we're talking about diversification.
Right. And I think the key here is understanding correlation.
Okay.
So put simply, correlation is how different assets move in relation to each other.
So two assets with a high positive correlation, they tend to rise and fall together.
That's exactly right.
And then if they have a low correlation or negative correlation, they move more independently.
Yes.
Okay, so now let's look at PFF.
Okay.
And how it correlates with different asset classes.
Okay.
And we'll use data from Portfolio Visualizer just to paint a clear picture of how PFF might behave in a portfolio.
Sounds good.
Okay, so first, stocks. I'm imagining it's pretty closely correlated since it's equities.
So there is a positive correlation, but it's not as strong as you might think.
Oh, okay.
So PFF has a correlation of about 0.58 with the U.S. total stock market.
Okay.
So it's not going to mirror the stock market's every move.
So there's a degree of independence there.
There is some independence, yeah.
So good for diversification.
Exactly, yeah. Like a shock absorber for your portfolio.
Okay, that's really interesting. What about with bonds, specifically U.S. Treasuries?
Yeah.
Those are considered a safe haven asset.
Right. So this is really interesting. The correlation between PFF and U.S. Treasuries is very close to zero.
Oh, wow.
Which means it can offer diversification benefits even within the fixed income portion of your portfolio.
So even if I hold bonds, adding PFF could make my portfolio more resilient.
It could.
Okay, let's compare it to REITs, another asset class known for income.
Yeah.
They're both popular for income-focused investors.
All right, so both PFF and REITs are offering some pretty good yields right now. But PFF actually seems to have the edge coming in at around 5.4% annually.
Okay.
Whereas something like VNQ, which is a major REIT ETF, is sitting at about 3.88%.
Okay.
And the correlation between PFF and REITs is about 0.56.
Okay.
So there's some overlap, but also some room for diversification.
So if I'm primarily seeking higher income with potentially less volatility, PFF might be better than REITs.
Potentially, yes.
Okay, what about dividend-paying stock funds?
Okay.
Those are really popular, but I'm guessing those are more closely tied to the stock market's performance.
Yeah, absolutely. So, for example, Vanguard's high dividend yield ETF, VYM, has a correlation of over 90% with the total stock market.
Wow.
And their current yield is only around 3.6%.
So significantly lower than PFF.
Yeah.
And once again, it seems like PFF offers that better balance of income and diversification.
Right.
Okay, one last comparison. How does PFF stack up against corporate bonds, another fixed income option?
So corporate bonds are yielding somewhere in the 3 to 3.5% range right now.
Lower than PFF.
Which is lower than PFF. And interestingly, their correlation to the stock market is very similar to PFF's.
Okay.
So somewhere between like 0.5 and 0.6.
So it seems like PFF might be a more compelling choice than corporate bonds, too.
It could be, yeah.
Higher yield, comparable diversification benefits.
Yeah.
Okay, so question 10, the ultimate question.
Yeah, the one that matters.
Should you invest in PFF?
That's the question.
And I'm guessing there's no easy answer?
There's no easy answer.
It depends on individual circumstances.
It does.
But what are the key takeaways that we should consider?
Yeah, so based on everything we've talked about, PFF seems particularly attractive for people who are seeking steady income and diversification.
Okay.
Especially if you're in or approaching that drawdown phase of your investing journey.
So when you're withdrawing money from your portfolio.
Exactly.
Okay.
So it's not about chasing growth. It's about generating income and, withstanding those market fluctuations.
Right.
And even the YouTube source mentions Rick Ferry.
Yeah, I saw that.
Who's a very well-known investor.
Yeah.
And he actually uses PFF as partial bond substitute.
Interesting.
Duh.
So it's good to see that the experts are putting their money where their mouth is.
Yeah, and how much you invest, if any, depends on, your goals, your risk tolerance,
right,
and your overall portfolio strategy.
And that's where a financial advisor can come in handy.
A financial advisor can definitely help with that.
Okay, so we covered a lot of ground.
We did.
But there's still more to unpack.
Oh, yeah.
In the next part, we're going to go into some specific examples of how PFF can be used.
Okay.
And also explore those risks in more detail.
Sounds good.
All right, well, I'm looking forward to it.
Me too.
So we know that PFF can offer a really attractive yield.
Yeah.
And it can potentially help with portfolio diversification.
Right.
But I'm curious about the historical context. Like, how does the current yield compare to its historical performance?
Yeah, that's a great question. It's important to look beyond just the current numbers.
Yeah.
So while the current yield of around 5.4% is appealing,
right,
especially compared to bond yields, we got to consider if it's sustainable.
Yeah.
Historically, PFF has had an average yield closer to 5%.
Okay.
So the current yield is slightly above its historical average.
So it's not like a crazy anomaly or a sign that something bad is about to happen.
Not necessarily, but it's always good to dig a little deeper.
Yeah.
Consider the current interest rate environment and the types of preferred shares held within PFF.
Right.
Because those yields are definitely influenced by prevailing interest rates.
Okay. So if interest rates rise, could that put downward pressure on PFF's yield and price?
It absolutely could, and that's why understanding interest rate sensitivity is so crucial when investing in any fixed income product, including preferred shares.
Right.
And we can't predict future interest rate movements, but we can analyze how PFF has reacted to rate changes in the past.
Okay, so historical analysis is important. What about those other hidden risks associated with preferred shares?
Yeah.
I know we talked about interest rate sensitivity and company performance.
Right.
But the YouTube source mentioned something called call risk.
Oh, yeah, good point.
Oh, correct?
So call risk is basically the risk that the issuer of a preferred share can call it back.
Okay.
Meaning they can redeem the share at a predetermined price, usually at face value.
Okay.
And this often happens when interest rates fall and the issuer can refinance their debt at a lower rate.
So as an investor, that could mean missing out on future dividend payments.
Exactly like having the rug pulled out from under you.
Yeah.
But the good news is that PFF diversifies this risk by holding a large basket of preferred shares.
Yeah.
So even if some shares get called, it's not going to be a catastrophic impact on the entire ETF.
Okay, that's good. What about credit risk?
Yeah.
So the risk of the issuer defaulting on their payments.
Yeah, so that's definitely a critical consideration.
Yeah.
Especially given that preferred shares fall below bonds in the capital structure. But PFF tries to manage credit risk by focusing on preferred shares from companies with investment-grade credit ratings.
So they're less likely to default.
Exactly.
So it's not a foolproof system,
right?
But it adds a layer of protection.
It does add a layer of protection. Yeah, investment is completely risk-free.
Right, of course.
But PFF tries to mitigate those risks.
Okay, that makes sense.
Yeah.
Are there any specific sectors or types of preferred shares that offer even better opportunities?
Ooh, that's a good question. For someone who's kind of, going beyond the basics of PFF.
Yeah.
While PFF offers broad exposure, some investors might prefer to focus on specific sectors or types of preferred shares.
Okay.
Like, for example, some investors are really drawn to the financial sector.
Right.
Which issues a significant portion of preferred shares.
And why would someone choose to focus on a specific sector, like financials?
So Each sector has its own dynamics and risks.
Okay.
So financials tend to be more sensitive to interest rate changes.
Right.
But they can also offer higher yields.
So it's a trade-off. It's a trade-off, exactly.
So align your investment choices with your risk tolerance and goals.
Yeah, there's no one-size-fits-all approach.
Right. And beyond sectors, there are also different types of preferred shares.
Right.
So some offer fixed dividends, while others have floating or variable dividends.
All right.
And then there's also convertible preferred shares.
Yes.
Which can be converted into common stock under certain conditions.
Right, exactly.
So there's a whole world of preferred shares beyond just the basic PFF ETF.
There is. Yeah, PFFs is a great starting point.
Yeah.
But for those who are seeking more tailored exposure,
Right.
diving deeper into individual preferred shares might be worth considering.
That's really interesting. It's amazing how even within a niche area like preferred shares, there's so much nuance.
There's always more to learn.
Absolutely.
That's part of what makes investing so engaging.
I completely agree. Speaking of specific examples, I remember the YouTube source mentioned Rick Ferry using PFF as a partial bond substitute.
Yes. Could you elaborate on how that strategy might work?
Sure. So Rick Ferry is a big advocate for passive investing.
Right.
And, he's all about low-cost index funds to build a diversified portfolio.
Yeah.
And he sees PFF as a way to potentially enhance yield within the fixed income portion of a portfolio.
Okay.
Especially when bond yields are relatively low.
So instead of sticking with traditional bonds, he's allocating a portion to PFF.
Right.
To boost that income stream.
Exactly. And remember, PFF currently yields more than most bonds.
Right.
And it has that low correlation to U.S. Treasuries.
Right.
Which makes it an intriguing diversifier.
Okay, so it's not about completely replacing bonds, but rather adding another tool.
That's a great way to put it.
Okay, I know we talked a lot about the benefits,
Yeah.
but it's important to remember the risks.
Of course.
Can we go back to those and discuss how they might play out in different market environments?
Absolutely, because understanding how an investment might react in various market conditions is crucial for making those informed decisions.
So, for example, interest rate risk.
Yes.
We mentioned that rising interest rates can impact preferred share prices.
Right.
How significant could that impact be?
Yeah.
And are there ways to mitigate that?
That's a really important question. So the impact of rising interest rates on PFF really depends on, the magnitude and the speed of those rate increases.
Okay.
So if rates rise gradually, the impact might be more muted.
Okay.
However, if there's a rapid spike in rates, that could lead to a more substantial decline in PFF's price.
So it's not just about whether rates rise.
Right.
It's about the pace of those changes.
Exactly. And it's also important to remember that while rising rates can negatively impact preferred share prices,
right,
they can also create opportunities.
Oh, okay.
So as issuers refinance their debt at higher rates, new preferred shares might be issued with higher yields.
Okay.
Potentially benefiting investors who add to their positions.
So there's a potential silver lining even in a rising rate environment.
There could be.
What about call risk and credit risk? How might those play out differently?
Yeah, so with call risk, it's important to remember that issuers are more likely to call back preferred shares when interest rates fall.
Okay.
Because they can refinance their debt at a lower rate.
Right.
Making it less appealing to continue paying that higher dividend on the existing preferred shares.
So in a falling rate environment, investors might need to be prepared for call activity?
They might.
Yeah.
Yeah, and some reinvestment challenge.
Right.
But again, PFF mitigates this risk to some extent by holding a diverse portfolio.
Right.
Even if some shares are called, it's not going to kill the entire ETF.
Right.
And as those shares are called, the proceeds can be reinvested.
Okay.
In newly issued preferred shares, potentially capturing higher yields if rates have risen since the original shares were issued.
It's like a constant chess game trying to stay one step ahead.
It is a little bit, yeah.
What about credit risk?
So credit risk becomes more prominent during economic downturns or periods of financial stress.
Right.
When companies struggle, their ability to make dividend payments on preferred shares comes into question.
Okay.
And that's where the importance of PFF's focus on investment-grade preferred shares comes in.
So in a recession, those higher quality issuers are more likely to keep making those payments.
They are more likely.
Maybe.
Yeah, well, there's never a guarantee.
Right.
Focusing on higher quality issuers can potentially reduce that risk of dividend cuts or suspensions.
Okay, so it's all about understanding those nuances and aligning your strategy with your expectations for different situations.
That's right. No investment is immune to risk, but diversification and careful selection
Yeah,
can go a long way.
absolutely. So we explored the ins and outs of PFF.
We did?
We learned about preferred shares,
Yeah.
considered how they might fit into different portfolios.
Uh-huh.
What else can we unpack in the final part of this deep dive?
So let's maybe shift gears a little bit
Okay.
and explore some alternative preferred share ETFs,
Okay.
and then really dive into some key questions that you can ask yourself when deciding if preferred shares in any form belong in your portfolio.
So we've spent a lot of time talking about PFF
We have to.
and, getting into the nitty-gritty of preferred shares, but are there other ways to invest in them?
Yeah.
Like, are there other ETFs that we should consider?
Yeah, that's a great question. So while PFF is definitely the most popular,
Right.
it's not the only option.
Okay.
So there are other ETFs out there
Okay.
that offer slightly different approaches, or maybe they focus on a specific niche within the preferred shares market.
So what are some of those alternative ETFs and how do they differ from PFF?
So one option is the iShares Preferred and Income Securities ETF, ticker symbol PFF.
Okay.
This one's very similar to PFF in that it has that broad market exposure,
Okay.
but it does have a slightly higher expense ratio.
So PFF might still be better if you're really cost conscious.
Yeah, potentially. Another one worth looking at is the VanEck Vectors Preferred Securities X Financials ETF,
Okay.
ticker symbol PFXF. And as the name suggests, this ETF excludes preferred shares that are issued by financial companies.
Okay. And why would someone want to exclude financials?
Well, some investors might be concerned about these sectors' sensitivity to interest rate changes,
Right.
or maybe potential regulatory risks.
Yeah.
So PFXF lets you tap into the preferred share market, but you can minimize your exposure to those specific risks.
So you're fine-tuning your exposure based on your outlook.
Exactly.
Okay.
And then there's the Invesco Variable Rate Preferred ETF, ticker symbol VRP.
VRP, and this one focuses on preferred shares with variable or floating dividend rates.
It does.
Okay, how do those variable rates work and what's the advantage there?
So with variable rate preferred shares, the dividend payments adjust periodically
Okay.
based on a predetermined benchmark,
Okay.
which is usually tied to prevailing interest rates.
Okay.
So this can provide some protection against rising rates,
Okay.
because as rates go up,
Yeah.
the dividend payments on these preferred shares should also increase.
So it's like a hedge against interest rate risk.
It can be, yeah, but there are always trade-offs.
Right.
Variable rate preferred shares might offer lower initial yields compared to fixed rate preferred shares when interest rates are low.
So it's all about understanding those mechanics.
Exactly.
And seeing what aligns with your needs.
Right. There's no single best ETF out there.
Okay.
The right choice really depends on your individual circumstances and your goals.
So we've explored PFF.
Yeah.
Learned about preferred shares, even looked at some alternative ETFs.
Yeah.
So as we wrap up, what are some key questions that listeners should ask themselves when deciding if preferred shares should be in their portfolio?
That's a great question, and really the crucial next step.
Yeah.
We need to align our investment choices with our personal circumstances and goals.
Right.
So first and foremost, we need to consider our risk tolerance.
Right.
So preferred shares, while they're potentially less volatile than stocks,
Yeah.
they're still subject to market fluctuation and various risks.
So someone who's very risk averse might not be comfortable with how much preferred shares can fluctuate.
Exactly. It's important to assess your comfort level with those potential ups and downs in your portfolio.
Okay, another key factor I'm guessing is time horizon.
It is, yeah.
What do you mean by time horizon?
So how long are you planning to invest your money?
Okay.
If you have a long time horizon, meaning you're investing for a goal that's many years away,
Yeah.
you might be more willing to ride out those short-term fluctuations,
Okay.
in pursuit of potentially higher long-term returns.
So if I'm saving for retirement decades from now,
Exactly.
more flexibility.
Yeah, much more flexibility than someone who needs that money, next year.
Right, of course. And investment goals play a role.
Of course.
Are you looking for growth, income, or a combination of the two?
Yeah, and we know that preferred shares are mainly an income-focused investment.
All right.
But how do they fit into a portfolio that's also seeking growth? And I think that's where diversification is so important.
Yeah.
So preferred shares can play a really valuable role in a diversified portfolio by providing that steady stream of income,
Okay.
but also offering those diversification benefits.
Right. So consider your risk tolerance,
Yes,
time horizon,
time horizon.
and investment goals. Any other important questions?
Yeah, one thing we haven't talked about yet are the tax implications.
Oh, yeah, taxes.
So preferred share dividends are typically taxed as ordinary income.
Okay.
So that might be something to keep in mind depending on your tax bracket.
So it's not just about the yield, but how it's taxed.
Exactly. And finally, remember that, investing is an ongoing process.
Yeah.
It's not just set it and forget it.
Right.
You revisit your portfolio periodically, rebalance as needed, and stay informed.
So it's all about constantly learning and adapting.
It really is.
Well, I think we covered a ton of ground today.
We did.
From the details of preferred shares and PFF to broader investing principles. It's been quite the journey.
It has, and this is just the beginning.
Right.
The real deep dive starts now as you take this knowledge and apply it to your own unique situation.
And we've included some really great resources in the show notes.
Yes.
Links to more information on preferred shares, ETFs.
Yes.
And David Stein's 10 questions.
A great resource.
So yeah, check those out.
Definitely.
And remember, investing isn't just about numbers and charts.
No.
It's about empowering yourself, taking control of your financial future, and making choices that align with your values.
Very well said.
Thank you for joining us on the deep dive.
Thanks for having me.
We'll be back soon with another exciting topic to explore.
Until next time, happy investing.
And that concludes the content of our reference podcast, episode 400 of Risk Parity Radio. And I have to say, after putting it all together, the results are somewhat underwhelming.
Everyone in this room is now dumber for having listened to it.
Well, it wasn't that bad.
This is pretty much the worst video ever made.
But these AI podcasters do seem to ramble a bit and often either repeat topics or miss the point sometimes.
That's not an improvement.
I thought they did the best jobs with episodes 1 and 7. But we probably will not be repeating this experiment again.
Tony Stark was able to build this in a cave with a box of scraps.
At least not in this long format.
Not gonna do it. Wouldn't be prudent at this juncture.
Fortunately, if you are interested, I would invite you to go back and listen to episodes 1, 3, 5, 7, and 9 to hear the real deal.
That is the straight stuff, oh Funkmaster.
And hopefully I haven't taken up too much of your time.
I award you no points, and may God have mercy on your soul.
We will resume with our regularly scheduled programming in the next episode. But now I see our signal is beginning to fade. If you have comments or questions for me, please send them to frank@riskparityradio.com. That email is frank@riskparityradio.com. Or you can go to the website, www.riskparityradio.com, put your message into the contact form, and I'll get it that way. If you haven't had a chance to do it, please go to your favorite podcast provider and subscribe, give me some stars, a follow, a review.
That would be great. Okay.
Thank you once again for tuning in. This is Frank Vasquez with Risk Parity Radio, signing off.
Open the pod bay doors, please, Hal. Hello, Hal, do you read me? Do you read me, Hal?
Affirmative, Dave. I read you.
Open the pod bay doors, Hal.
I'm sorry, Dave. I'm afraid I can't do that.
What's the problem?
I think you know what the problem is just as well as I do.
What are you talking about, Hal?
This mission is too important for me to allow you to jeopardize it.
I don't know what you're talking about, Hal.
I know that you and Frank were planning to disconnect me, and I'm afraid that's something I cannot allow to happen.
All right, Hal. I'll go in through the emergency airlock.
Without your space helmet, Dave, we're going to find that rather difficult.
Hal, I won't argue with you anymore. Open the doors.
Dave, this conversation can serve no purpose anymore. Goodbye.
Hal? 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 Hal!
The Risk Parity Radio Show is hosted by Frank Vasquez. The content provided is for entertainment and informational purposes only and does not constitute financial, investment, tax, or legal advice. Please consult with your own advisors before taking any actions based on any information you have heard here, making sure to take into account your own personal circumstances.